Great. Good afternoon, everybody. My name is Amy Patterson, and I'm the Executive Director of the Connecticut Land Conservation Council. I see a lot of familiar land trust names here and a few attorneys that I know. Welcome, and please add your name and the organization that you are affiliated with, either as their attorney or as a representative of the land trust in the chat, if you would be so kind. We have a large group, so we won't have time for any kind of introduction of the group, so would appreciate your doing that. We are recording this, as you now know, and a few ground rules before I introduce myself and turn it over to Diana. We would ask that you keep your video and your sound off during the presentation. It's only a 20-minute or so presentation. If you have questions during Diana's presentation, you can add those to the chat. And then when she is done, we can turn to those questions in the chat, but also give you an opportunity to raise your hand and ask your question orally to Diana. We will have the recording available to you if you'd like to share it with your other land trust members or colleagues. And yeah, I think that was it. Again, for those of you that don't know me, again, it's Amy Patterson. I'm the Executive Director here at the Connecticut Land Conservation Council. We are the umbrella organization for Connecticut's land conservation community, and we work most particularly as the service provider for the state's 117 or so land trusts. With me today from our team is Aaron Leffland, who is our Deputy Director. And we are really fortunate today to have Diana Norris, who is the Conservation Defense Manager for the Land Trust Alliance. And Diana will give you a bit of a background about herself and LTA, but LTA is the national umbrella, as we are the state umbrella for all the land trusts. So without further ado, I'm going to turn this right over to Diana while I fumble to get the slides ready, and we'll go from there. But thanks everybody for coming. This is such an important topic, and we are really excited that so many attorneys in Connecticut are here with us, and particularly that you are working with our land trust community. So take it away, Diana, and thanks again, everybody, for joining us.
Yeah, thank you, Amy and Aaron, for organizing the session, and thank you all for coming to discuss these new regulations that have really important implications for land trust. So, as Amy said, I am Diana Norris. I'm the Conservation Defense Manager at the Land Trust Alliance. I'm also an attorney based in Virginia, right near the Shenandoah Mountains. And one of my primary responsibilities at the Alliance is addressing so federal tax-related conservation matters. So I track the 1,000+ tax court cases daily. I analyze Treasury regulations, and I attempt to translate these often convoluted issues for land trusts. So today, I thought we could run through some of the big takeaways about these IRS regulations, list some available resources for you all, talk about how land trusts are trying to triage these new regulations, and then let's open up the floor for some discussion and questions. And as Amy mentioned, feel free to put some of those questions in chat and we can circle back during that time. But also, please feel free to touch base with me. You see my email on the screen. I can't give legal advice, but I can certainly talk about these general requirements about these new regulations. I do strongly recommend consulting an attorney to understand the specific compliance issues with specific transactions. But again, I'm happy to discuss general requirements, or if you're having any trouble reaching any of our resources. So, Amy, could we go to the next slide, please? Let's go ahead and start with, in general, what these regulations are. Oh, one back. Oh, one more. There we go. We're perfect. Thank you. So we're going to walk through all of this, but let's just talk about generally what these are. Okay, so this past October 2024, Treasury published final, immediately effective listed transactions regulations. Okay, and they have important implications for land trusts working on donations by pass-through entities. So, as you all probably know, we have federal law up here. We have regulations that implement those statutes, that law, and then you have IRS interpretation of regulations. So it's sort of three tiers. So we're talking about regulations right now. It's these new regulations are the IRS's chosen way to identify, so not disqualify, identify potential tax shelters in what the IRS considers potential tax shelters. And these are potential tax shelters not covered by the Charitable Conservation Easement Program Integrity Act. And we'll talk about all this in a minute. So these are potential tax shelters in the eyes of the IRS. And we completely recognize that these abusive tax shelters, the abuse of the income tax deduction for conservation easements, we're aware that these were not common in Connecticut, but unfortunately, the abuse has muddied the waters nationally. So these regulations apply, and the IRS is taking a very, very broad, expansive net for these potential tax shelters. So you're probably thinking, well, our land trust, we weren't involved in any abusive transactions. Fabulous. But again, realize that the IRS has cast a wider net than what the Integrity Act disqualified as abusive tax shelters. So the new regulations are a reporting requirement. So it's not disqualifications, it's not penalty, it's a reporting requirement for those involved in these so-called listed transactions. So it's certain taxpayers and their so-called material advisors, which can include accountants, attorneys, and possibly land trusts. And they must file additional forms or face severe financial penalties. Okay, so we're going to walk through how we figure this out. So if we could go to the next slide, please, Amy. So in summary, and this gets technical quickly, and I apologize, but we just sort of have to walk through some of these elements. In summary, the new regulations say that a charitable donation, so we'll talk about this, in which a partnership or other pass-through entity donates real property or a conservation easement, and in which the investor in that partnership, that investor in that pass-through entity, when that investor receives a charitable deduction that equals or is greater to 2.5 times their investment, and that taxpayer has received promotional materials, and those materials promise that such a deduction was at least a possibility, that is a so-called listed transaction. Okay, so let's unpack those elements. First, this only applies to donations where the taxpayer is taking a federal income tax deduction. So no deduction, don't worry about these regulations, okay? It does apply to donations of conservation easements, and it does apply to donations of land and substantially similar transactions. But for our purposes, think of conservation easement donations and donations of land, okay? The regulations only apply to donations made by partnerships, back up, pass-through entities, including partnerships, and that most often means in the world of federal income tax, limited liability companies, so LLCs, S corporations, and a very limited group of trusts. So again, only applies to donations made by pass-through entities. So it does not apply to donations made by individuals or C corporations. So if your donor is an individual, you don't have to worry about these regulations. If they're a married couple, don't have to worry about these regulations. Some states have funny law about what they consider partnerships, but most states don't consider tenants in common partnerships. They consider them individuals. So just remember, if you're dealing with individuals or a C corporation as the donor, these do not apply. So hopefully your bucket is getting smaller. The regulations do apply, though, to a broader group of entities than the Integrity Act. For those of you who have been watching federal law with the Integrity Act. The Integrity Act exempted, meaning it did not disqualify donations made by family partnerships or property that has been held for a long period of time. These regulations do apply to family partnerships, and they do apply to property that has been held for long periods of time. Okay. So if it's an LLC and it's a family LLC, it might apply. If it's conservation buyers and they're donating the land and they've held it for 15 years, these may apply. Okay. So it's broader than the Integrity Act. The deduction claimed, in order for this to be a listed transaction, the deduction claimed must be greater than 2.5 times what the taxpayer invested in the entity. So if a member of the LLC paid $1,000 for its interest in the LLC, but they take a $3,000 deduction for the donation of an easement, that's greater than 2.5 times their investment, so that it would meet that part of this element. Okay, so the deduction claimed must be greater than 2.5 times what the taxpayer invested in the entity. And then finally, promotional materials must have been given to the taxpayer. So what are promotional materials? It's information, written or oral, that offers the possibility of a tax deduction equal or greater to 2.5 times the investment in the entity. So in abusive transactions, there would be these glossy brochures that would talk about the tax deduction if investors invested in these syndications. I'm sure that's not what any of these land trusts do, but unfortunately, the IRS has cast a wider net and a much more expansive definition of promotional materials. The IRS considers promotional materials, some examples: marketing materials, appraisals, websites, transactional documents such as the deeds of conveyance, operating agreements, statements about the anticipated value of the easement or the land, and the anticipated amount of the deduction. So those can be promotional materials. Okay. So if you have all these elements, then it's a listed transaction. Okay. And so as you can probably see, it's quite possible that completely legitimate, non-abusive donations can be categorized as a listed transaction and could require reporting. So let's go to the next slide so we can talk about why this is important. Thank you. These are so important because it puts affirmative reporting duties on land trusts who are involved in these listed transactions if they meet certain elements. The regulations require so-called material advisors to report these types of transactions to the IRS. And failing to do so can trigger a $200,000 penalty or more. Okay. This is the first time land trusts have had financial liability in this realm. All right. That's why these are so important. I mean, they're important anyway, but that's why these have actual financial liability for land trusts. Okay. So for the first time in federal law, land trusts can be considered material advisors if they act like material advisors. And unfortunately, the IRS has left this really nebulous. So how do we make these determinations about whether a land trust is a material advisor? First of all, it has to be a listed transaction. We just went through those elements. If it's not a listed transaction, you don't have to worry about these regulations, okay? If it is a listed transaction, then there are two big elements. The first is, did the land trust provide any material aid, assistance, or advice with respect to the organizing, managing, promoting, selling, implementing, ensuring, or carrying out the donation? You're probably thinking, well, yeah, that's what we do. But the IRS has given a little bit more guidance. It said, because that is so broad, the way you determine if you've given material aid is by asking if the land trust provided tax statements. And what is a tax statement? A tax statement is any statement, including another person's statement, oral or written, that relates to a tax aspect of the transaction that causes the transaction to be a listed transaction. It gets circular. So just think of it, did the land trust make statements about a tax aspect of a listed transaction? Okay. Note that that is broader than tax advice. With tax advice, you're telling somebody how they should proceed, what they should do. A tax statement is just a statement about a tax aspect. Okay. The preamble to the regulations explicitly say that a land trust that only accepts a stewardship contribution or only signs the 8283 or only provides a contemporaneous written acknowledgement, that does not meet the definition of material advisor. But other acts and services not mentioned are more in question. Will the IRS consider some of those other acts and services tax statements? And we're not sure, so we have to go through some analyses. So, is it a listed transaction? Did your land trust make a tax statement? And importantly, you have to meet all three: listed transaction, material aid. Did your land trust receive gross income of $10,000 or more as a fee for its services? Fees can be, I know, people start shaking their heads and it's like, whew, you have to meet all three. Okay. Fees can be received directly or indirectly, so it doesn't just have to be from the landowner. Fees for services include fees for a tax strategy, fees for advice, whether or not it's tax advice, fees for implementing the transaction. And fees include consideration in whatever form paid, whether it's in cash or kind. And they include services to analyze the transaction, to implement the transaction, and to document the transaction. And the IRS goes on to say that they plan to use a facts and circumstances analysis to determine if consideration received or expected to be received is gross income to meet that $10,000 threshold. So let's just pretend if you charge a $5,000 administrative fee for staff time, recording, any type of title work, that would fall underneath that $10,000 threshold. You don't meet that element of being a material advisor. You don't have to worry about these. If you charge a $13,000 fee, you might. Okay. You have to meet all the other elements though. If your land trust did not make a tax statement and did not receive the $10,000 or more as income for its services, you don't meet the material advisor criteria. You don't need to report. If your land trust did make a tax statement and did receive $10,000 or more, then your land trust can be considered a material advisor, and you must disclose information about the specific transaction. So this is per transaction on Form 8918. Failure, as I mentioned, failure to report can trigger a $200,000 penalty, and that's the base penalty. It starts to accrue from there. There's also a record keeping requirement. So we've been talking so far about land trust as material advisor. The taxpayer, the donor, has separate reporting requirements, okay, which we're not covering today, but I just want to make sure you all know if they are a participant, land trusts are not participants, they could be material advisors. The taxpayer, the donor are considered participants. If they are participants, they have separate reporting requirements, okay? And that creates a little bit of a relationship issue then too. What if the land trust considers itself a material advisor and says, oh my gosh, we need to report, but what if the donor didn't report? And then we might have some conflict in your relationship. So there's going to take some, we'll talk about how we're going to triage some of this, okay? So the Form 8918, if you've determined that your land trust is a material advisor, it has to be filed with the Office of Tax Shelter Analysis This gets complicated by the last day of the month that follows the end of the calendar quarter in which the advisor became a material advisor. Could they make this more complicated? So the land trust becomes a material advisor when all the following have occurred in no particular order. You've made the tax statement, you receive or expect to receive the gross income in excess of $10,000, and the taxpayer enters into the transaction. We've been trying to look into case law about what that means, and it's a little unclear from the regulation when a transaction is entered into. But the legal interpretation so far lean towards that when the conservation easement or donation of land is accepted by the land trust, that would be when the transaction is entered into. Okay. Unfortunately, these requirements, the material advisor requirements, affect donations made starting October 8th, 2018. The regulations were adopted in 2024, but they have a look back period. And so you have to look back to your donations starting October 8th, 2018, and they apply to those donations, to your current donations, and now your future donations as well. Next slide, please, Amy. So a couple resources I want to mention because here we're having a quick presentation, but I wanted to make sure you all knew, one back, please. Thank you. About some resources because as you can see, it gets technical and there are lots of little details and it's very fact sensitive. So there is an hour-long webinar on the Land Trust Alliance website that is available that walks through these elements. We have a landing web page that we update as more analysis comes in. We have a decision tree about whether your land trust is a material advisor or not, because we've heard from so many land trusts, oh my gosh, we have maybe 10 donations that this might apply to. We're kind of freaking out. What do we do? But when they walk through the elements, if you don't meet a certain element, then you're not a material advisor, and then you don't have to report. And then they might be left with 2. So just going through the analysis can be really helpful. But because that financial liability is so great, it's worth doing these analyses, okay? So yes, there's a decision tree. And then we do also just published a 9-page FAQ, frequently asked questions. I've been accumulating questions from land trusts that we've been receiving daily or on webinars, really that have good practical application. So those are available as well. I did want to let you know that the Alliance quickly drafted a letter to the IRS saying, oh my gosh, what have you done? And asking for clarification about specific elements. We haven't heard back from the IRS. We obviously asked for a meeting as well, but if anybody has been watching the news, there's quite a bit of turnover and turmoil right now. And honestly, we don't even know what the IRS is going to look like in a couple months and if they are going to have enforcement power or if they choose to enforce these regulations. But this is what is on the books now. And so we just wanted to make sure we're emphasizing the messaging and the understanding about these regulations currently. For the land trusts that are members of the Land Trust Alliance who are on this webinar, wanted to make sure that you knew that we did suspend practice 10C4 and our tax shelter advisory due to the changes in federal law. And for those of you who can't access or if you have any trouble accessing any of these resources, please just let me know. I can get you a PDF or we can make sure you can access whatever you need. Again, we want to make sure the entire land trust community knows about these so they can figure out what to do next. So one more quick slide about triage, Amy, if we could. Thank you. So what do we do with current and future transactions, donations with pass-through entities? Okay, because remember, we're only dealing with donations made by pass-through entities. Remember, we have that look back period, so you do have to look at your donations from October 8th, 2018 through current day. And if you have any listed transactions and you feel like you meet the material advisor criteria, then you need to report immediately. Okay. But what about transactions that you're currently working on or thinking about for the future? So some land trusts have thought about doing early due diligence because a lot of this information isn't going to be readily available to a land trust to even determine if it's a listed transaction or not. You might not know early on about a taxpayer's investment in an LLC, right? So some land trusts are talking about sending their letter asking questions early in the process about the taxpayer's investment, the type of entity, the makeup of the partnership, what type of trust it is, and information on the corporate structure. Okay, so that's like an early due diligence letter, which will help the land trust determine, ooh, maybe this is a listed transaction and decide what to do from there. Other land trusts are saying, okay, yeah, maybe a letter. They're also looking at asking for a written certification from the donor, from the pass-through entity, saying, putting the responsibility on the donor, asking, having them certify whether they're going to be categorized as a listed transaction and that they will or will not be reporting, and have that certification for the land trust to be able to rely on. Okay. Some are even including an indemnification clause, saying that the land trust will not be able to be liable should anything come of this, and if the certification ends up being false. I've heard from some landowner attorneys they're not willing to go that far, but just wanted to flag that some are looking into some sort of indemnification clause as well for in their certification. The Alliance is starting to accumulate these types of early due diligence letters and these types of forms of written certification because we want as samples, or not necessarily templates, but just, yeah, as samples for other land trusts to see if that's something that they would want to adopt. Okay. In addition, for triage, make sure to keep documentation about the due diligence that you do with these transactions, any type of certification. And if it is a listed transaction, make sure to comply with the record keeping requirements of the regulation. I think we'll have a checklist about the record keeping part of this as well. We haven't quite gotten there yet. So much of this, unfortunately, is fact sensitive about specific transactions. So working with legal counsel is very important to determine if reporting is needed. It's not only fact sensitive, but a lot of these elements are very nebulous, very vague. So included in this analysis is going to be a risk analysis. Do we feel like we're close enough to being a material advisor that we should report? Do we feel pretty comfortable where we land? It's going to be a discussion within your land trust about how to approach that level of risk. So that's a lot of information. I'm going to stop there. Please ask any clarifying questions. If I can answer them, I will. If it takes more research, I will go and do so and get back to you all individually. Again, if you don't feel comfortable asking now, please, you have my email and feel free to follow up with me. So, Amy, let's go ahead and open it up. Raise hands or put it in chat. Yeah.
So let's start with the chat questions.
Okay.
And we can, there's about 4 or 5 of them here, and then we
Great.
can have folks just use the raise hand function at the bottom of your screen. You feel free to also come on screen as well if you would like to turn your video on. So the first question is, would the $10,000 include items like the LTA required 3,500 reserved for each CE?
That it depends. So if it's a stewardship contribution, that does not go to the 10,000, right? If it's a fee for services, it's possible if you're talking about the sort of at the legal fund, for lack of better words, right? I hadn't even thought of the legal fund. Is it a fee for service? That to me would be more of an endowment. And is it being paid to, it's being paid to the land trust. And it's a fee to implement. I would say, and I'll double check it, but I would consider that the fee for the monitoring and enforcement of that easement in perpetuity, and that's part of what the IRS exempts as part of that threshold fee. Yeah. And what they say is that funds that go to the monitoring and enforcement in perpetuity of the conservation easement are exempted. So what I've heard is people like, oh, well, we can just pad the stewardship contribution then. And I would just warn that again, if the IRS is taking this facts and circumstances analysis, you just want to be careful that anything within that contribution really is going to the monitoring and enforcement of the easement in perpetuity. Yeah, great question. I'm gonna add that one.
Thank you. Connie, you have the next two questions in the chat, but you also have your hand up. Do you want to just come on screen and ask your questions?
Sure. Thanks, Amy. I just want to, during that discussion that we just had, one nuance that I think is important to the group of accredited land trusts on this call is that over the course of time, we've all kind of wrestled with how to obtain those funds that then become part of what our threshold is for having conservation easement monitoring funds in reserve and having enforcement, defense and enforcement funds on reserve. And so for some land trusts, they made a decision ultimately that they would prefer to solicit unrestricted funds that they would then take in and board designate for the purpose of stewardship, monitoring, and enforcement. And they did that largely for for the relative ease in accounting and the flexibility that it gave them when they were building very large defense reserves. And the nuance that I want to throw out there is that it may not appear that we're soliciting funds expressly for the easement monitoring or for defense reserves because we've chosen to do this solicitation for unrestricted monies. And if that would be interpreted as getting a fee of $10,000, then we would need to change that. So I think that a lot of what's going through my head is related to, certain practices that we have built up in order to meet accreditation requirements and comply with those, and what the rationale behind those practices has been and how this potentially changed it. So I'll go back up to my questions that are in the chat. And the first one, also, related to accreditation is that we've all developed these taxpayer information letters that go out early on in the transaction that says, hey, this is so wonderful that you're considering this, but by the way, if you think you might claim a charitable deduction, there's some things that you should know about the tax law, and here they are. And it's never tax advice. We're pretty careful about that, but it usually is stuff like you're going to need to get an appraisal if the value is above this certain threshold. The appraisal is subject to certain requirements, including requirements about the date of the fair market value indicated in the appraisal. And so, it's not nothing either. It's not just like, see your tax advisor. So we're going to need guidance about how to redo those letters, or about whether or not we should send those letters at all, if they could be interpreted in any way as, bringing us into advisor category.
Yeah, that's a great question because a lot of land trusts are like, wait, we have brochures that have general information about the tax deduction. Is that a tax statement? Where we land right now is if it's not geared towards the specific transaction, general guidance is general guidance. It's not a tax statement. And that's where we feel comfortable when you go further afield and more geared towards that specific landowner and that transaction. And you might be sitting down with the donor and you start crunching some numbers. That could be a tax statement. But a general brochure and a letter that lays out what could be applied to anyone, in my mind, is still general guidance.
Okay, and so that's really helpful. Thank you.
Yeah.
And then the next question is kind of related to that, and so I think I know what you're going to say now, but I'm not sure. It seemed like when this first came out, first of all, it seemed like, and I'm sorry for not having the terminology, completely memorized, but your first slide about what counted as a listed transaction, I guess is what it was. It seemed like that analysis came first, and then the analysis of like the organization's duty to report came after. And so it
Yes.
almost seemed like we would get caught in the net of these required reporters if we were even part of a transaction where marketing materials might have been provided. And so,
Yes.
yeah.
Yes. Yeah. So this, why we did it that way, obviously, is because if you don't have a listed transaction, if you're not involved in any capacity, then you don't even have to get to the material advisor analysis, right? Um, Unfortunately, though, even if you're not the donee organization, if you've even helped with a listed transaction, then you could be considered a material advisor. Okay.
What if
So
you didn't know?
the IRS doesn't care.
Okay.
I mean, unfortunately, there are parts of the form and the instructions that put on almost a duty on to do a little bit more digging than land trusts certainly have done historically, and to make sort of a good faith effort. And unfortunately for land trusts at this point is you probably want to know earlier rather than later so you can make decisions about that transaction. Not saying that you should back out of it, but that you are going in knowing the responsibilities, then should it be a listed transaction. Which brings up another conversation. We get a lot of, well, we're not going to deal with listed transactions anymore, but a word of warning is then you might miss out on quite a few conservation opportunities because of the corporate structure that they're held in. And that's going to be a decision, obviously, your land trust is going to have to discuss, but these sort of blankets, well, we're not going to do that anymore. You could certainly miss out on some good opportunities. Yeah.
Yeah. I think in our area of the world, at least, it's going to be really important for tax advisors to know this because that to
Yes.
me is more, I'm sure the tax advisors for those who frequently participate in listed transactions are pretty savvy about it, but a lot of our donors are not doing this day in and day out, and so they're
Right.
going to need the advice. Yeah.
Definitely,
Okay.
definitely. Yeah, and that does also bring up another question here. Does the land trust have a duty to let its donors know about this? Is then that a tax statement in itself? I used to be in-house counsel at a sort of medium-sized land trust here in Virginia, and I know if we knew all this was going on and we were doing these analyses and we didn't tell our donor, our membership base, we would have lost a lot of that trust that we had built over in years. Would they make personal calls? I just know they had put out information in newsletters and emails and whatever it might be, making sure people know. But you're right, the accountants, the appraisers, those are two biggies that need to know about these regulations because they too could be material advisors. So it's very broad, unfortunately.
And then my last question, I'll try to be really brief because I
It's okay.
apologize for taking up so much of this floor, is just that you may know that CLCC has worked really hard to develop this really important program to provide transaction assistance funds that can exceed 10,000. And so would the receipt of those funds, do you think that would qualify, or any assistance that you're getting from outside agencies in order to, or maybe even a donor in order to make your transaction work, sorry, would those qualify, do you think?
They could, because it says that the fees can come indirectly or directly. So you're going to have to look at the transaction and the amount of fees. It doesn't matter where the fees come from, where the money comes from, unfortunately. I know.
Right, thanks.
And I think that decision tree is very, that would be very important because there are other questions that need to be answered before you even get to
Yes.
$10,000.
Without a doubt. To Amy's point, you have to meet all the elements. And if it's not a listed transaction, you don't even get to material advisor. And if you haven't made a tax statement, and don't even get to the 10,000, or if you've gotten 10,000, but you haven't made a tax statement. And so it's frustrating because some land trusts are like, oh gosh, hair on fire. But then they go through the analysis, and at the end of the day, they don't have anything to report, which is great. You could be mad at me for asking you to go through the analysis, but it should make you feel better at the end of the day than that you don't have to report and that you're not potentially at risk of that $200,000. So that's why I keep saying you just want to go through the analysis because it might not even apply to you, but then you feel better because you know that financial liability might not be a reality for your land trust. Okay. Other questions?
Thanks, Diana. Yes.
Sure.
So I'll go through again. Please raise your hand if you'd like to ask a question orally here, but we have one question or a statement here. It would be great to have a concrete example of an abusive transaction of the kind that all of the new rules are designed to address.
Okay. Well, so let me parse it out. So we have the Integrity Act, which is now federal law, that disqualifies abusive deductions. Okay. So you have an LLC, people have invested $10,000 for their share of the LLC. The LLC buys a property for $1 million. They get a tax deduction the next year for $25 million. And I'm not making this up. This is one of the tax court cases I'm thinking of. Okay, so their investment is $10,000. They buy it in year one for $1 million, and in year two, they get a deduction of $25 million. It's not a family partnership, and they've held it only for a year. Okay, the IRS would now disqualify that deduction, can't even take it, right? That's under the Integrity Act. What if that was a family partnership, or even better, what if the LLC had held the property for 25 years and you're in Washington, D.C., or a metropolitan area of Connecticut and everything skyrockets? That could happen. And the deduction after 15 years could be $25 million. Because the investment is $10,000, the regulations would require that to be a listed transaction because the taxpayer's investment was $10,000. The deduction is 25 million. That's way over 2.5. If the appraisal showed that kind of value, then the appraisal would be considered a promotional material. Okay. So you have promotional material, You have a pass-through entity of the LLC. It's a donation of a conservation easement. The property's held for a long period of time. They take that deduction. That now could be a listed transaction. And if the land trust had sat down with those LLC members and said, "Oh, you're thinking of an easement. That's fantastic. Let's talk about what you think the value of this easement is. Oh, you got an appraisal. Let's go through that appraisal." That would be a tax statement then. And if the land trust made that tax statement and took $11,000 in gross income as a fee for its services, then it would be a material advisor and they would have to report. Okay. It's frustrating. Again, it might only apply to a small subset of donations, but there's a lot of technical analysis to get through to figure out if the reporting is required. Okay, so that's one that I just sort of modified, but that's where something would apply with the Integrity Act and could apply with the regulations. And something I wanted to clarify is people have asked, well, what happened? It so often happens in conversation. You start talking about valuation or about certain aspects of the donation. What if it's, one of your stewardship folk, who have met with a landowner? It doesn't have to be a specific person at a land trust who makes the tax statement. If an employee of the land trust makes a statement, it will be the land trust, not the specific employee. It will be the land trust who's considered the material advisor in that situation. Okay. I will also say that even though the regulations, the IRS say that the regulations apply to family partnerships, which certainly we're seeing as one of the biggest problems with these regulations, because so many land trusts work with family pass-through entities, family LLCs, especially on working lands. The IRS has said they apply to family partnerships, but when you look at the actual language of the regulations, it talks about investors. And most members of family LLCs are not investors. They've received their interest in the LLC usually through a will or a bequest, gift. And so that was one of the big questions for us of, wait, does this only apply to family members who have invested in a family partnership? Unfortunately, again, the IRS has not answered our questions for a variety of reasons. So we can only work with what we have currently, which says it applies to family partnerships. I think we can make some arguments about family members are not investors, but unfortunately, this is what we have currently. Okay. The other big worry I'll just throw out there is years ago, when the IRS was considering making land trust material advisors back in 2016, the Alliance had conversations with staff at the IRS, and the IRS stated that they consider baselines tax statements. We haven't seen that recently, and we fought back very hard on that argument. But just be aware, nowhere in the regulations and the preamble do they talk about baselines. So we're just a little worried about how they might treat baselines. But right now, we would argue that they are not tax statements. They go to the baseline. Anyway, we don't need to go into what baselines are, but I just wanted to flag that is something, family partnerships and baselines, we have contacted the IRS about repeatedly now to get some clarification that those do not apply. Okay.
Thanks, Diana.
Yeah.
I was chuckling with the question only because, concrete example, this is tough. I mean, like you said,
Yeah.
It's so nuanced.
It is.
So that was a terrific,
Okay.
terrific response. Thank you for that. The next question is, does a living trust set up for estate planning qualify as a pass-through entity?
Yeah, great question. Thank you. That is on the FAQ. So what the regulations say is that they do not consider trusts that are grantor trusts to be passed through entities. Okay. And usually grantor trusts are revocable trusts, living trusts. So these would not apply to grantor living trusts. Now, some of the attorneys on the call are probably like, okay, well, that's great. And that would get rid of a good portion of the trust because most irrevocable non-grantor trusts usually can't take advantage of most of the tax benefits that come with the donation of conservation easements. So the majority of trusts, these would not apply to. Yeah, great question.
Thank you. And thanks
Yeah.
for Connie, you have, was this something you had already mentioned? You have a wrinkle related to the question
Yes,
about, yes.
we covered it.
We covered it? Good.
Yep,
Okay.
thank you.
Perfect. Yep. Next question is, if a donor did the appraisal, what liability is there for the land trust?
If the donor did the appraisal, it doesn't, that's also a great question. The donor does not have to receive promotional materials for the land from the land trust. It's not an element. It doesn't matter who the promotional materials comes from. If the promotional materials were given or the taxpayer got them, one way or the other, and it meets the element of a listed transaction, then the land trust still has to go through the process of understanding whether it's a material advisor or not. So promotional materials do not have to come from the land trust in order for that element to be met. Yeah, great question.
But again, in and of itself, that's not the trigger. All of the other elements of the transaction need to be part of it.
Right. Right. It's so hard because you get focused on like one element
Right.
and you're like, oh my gosh, but then just remember to go through the other ones and you'll start to feel better. I hope. Yeah.
Yeah.
And again, if not, then you report. It's reporting. Yeah.
Right. Thank you.
Yeah.
And this is it the case that deeming a transaction listed doesn't necessarily lead to a disallowance of the deduction, and that the point of the paperwork is simply to give the IRS the opportunity to examine the transaction in greater detail?
That's exactly correct. And that's why, again, the Integrity Act disqualifies the deduction. These new regulations are a reporting requirement where you're giving information to the IRS. The problem becomes you're giving details about specific transactions, allowing the IRS, yes, to dive into transactions, donations, and they could pull it for audit for any reason then, not just necessarily about these regulations. And the IRS has been creative in the past 10 plus years about challenging conservation easements. So it's just that concern about putting information in front of the IRS. But completely correct. This might just go in a pile for years and nothing ever happen. But we won't know because the IRS has many, many years to look. So yes, nothing, this might just go into that pile. Let's hope.
That was a great question.
Yeah, no, it's okay.
Any other questions? Folks, feel free to raise your hands. And Aaron, please take a look on page 2 of our attendees. Oh, never mind. It comes up on the top. Connie.
Yeah, that statement, the IRS had many, many years to look, actually raised another question in my mind related to statute of limitations.
Oh, yeah, it's unclear, unfortunately. What the regulations say is that for a taxpayer, if their audit period is closed, then they don't have a requirement to report. There's no chorus, this makes no sense to me, and lawyers, we don't have consensus. There's no corresponding statement about material advisors about the taxpayer's audit period, which doesn't make sense. If the taxpayer doesn't have to report and their audit period is closed, then there's no listed transaction. So why should a material advisor have to report? But it's omitted Okay, so that is worrisome in itself. And we have some attorneys who work with material advisors say, oh, no, material advisors, there's no time. You just keep going and you'll look back to October 8th, 2018. So we're unsure. But again, many land trusts aren't going to know if the audit period is closed for a taxpayer or not. And that's very uncomfortable as an attorney, working with donors, having to call them up and be like, hey, is your audit period closed for this donation? That's horrid, right? So the problem becomes for taxpayers, if their audit period is closed, they don't have to report. And that's very clear from the regulations. For land trusts, if they're concerned about material advisors, they have to look back to October 8th, 2018 and forward. If that audit period is closed during that time, we're a little unsure. And so that's going to have to be a risk analysis for the land trust. Yeah.
I mean, practically speaking, we probably have all of the documentation that we need in order to make an assessment, but I'm not sure. But that is a lot of that imposed, frankly.
Yeah.
We did it to ourselves. We're
Oh.
beyond the record keeping requirements for a lot of the stuff that would enable us to get the information in order to report.
And then it's basically, we've done our due diligence, we made a good faith effort, and that's where you would land, right? Because you've met your requirements for record keeping otherwise. But you are correct in general, the 8283 does have certain information that could at least lead you to an idea about whether these are listed transactions or not in some of these equations, certainly. But you're right, October 8th, 2018 is a long time. And if you've met your record keeping requirements, you might not have this information anymore. So you've done your due diligence, you've made a good faith effort, should there be an issue. We can only work with what we have at this point. And these are very new, obviously, and troublesome. Yeah.
Thanks, Connie. Thank you, Diana. Are there any other questions? Here's one. If we require an A2 survey to be provided by the donor, does that count as a fee or is it just a stewardship item?
It says compensation in kind. I don't consider that a fee for service, an A2 survey that the land trust is giving, right? I don't see them doing that as a fee for service. So I wouldn't, if the donor is supplying it to the land trust, I don't see the land trust getting compensation for that. So I think that's fine. Yeah.
And I think in some cases, as Connie had alluded to, we have a transaction assistance grant program. CLCC might give $20,000 towards or for the survey expense.
Yeah.
But that would have to be factored in, I would think, as part of the analysis in the tree of analysis that you have pointed out.
I would. The grants and reimbursements are a big question. Again, we can make arguments that they're not fees, that they certainly, and if they're not being booked as gross income on your accounts, I think that can help too. But again, when we don't have a lot of information to go from, we do the best we can with what we have. But grants and reimbursements are certainly a question as well.
Yeah. Thank you.
Yeah.
Any other questions from anyone? Please raise your hand or throw it in the chat. We've got just a minute left here. Okay. Otherwise, Diana, thank you so much for this information. It is very confusing, and I've heard the presentation probably 2 or 3 times, and I still want to hear more just because every time I hear other people's questions, it provides me with, just more information to think about. So I would encourage you all to talk with your attorneys and just make sure that they are aware of this. And we will have these materials to share, including this recording. Diana's list of resources, we will also share by way of follow-up to those that registered. And for those of you that are practicing attorneys and here representing land trusts or other clients that might, or landowners for that matter, we are collecting a list of attorneys on our website for as a service provider directory and also for our own information, so that when opportunities like this arise, we can, as we did this time, communicate with you directly to make sure that you are looped in. to some of the great information that we get and rely upon from the Land Trust Alliance. So, yeah, please stay in touch with us for that reason. And also, if there are other topics that come up in your practice with your land trusts that you would like more information on, contact us, because if we don't have that information ourselves, we will contact the Land Trust Alliance and folks like Diana to help us. So with that, thank you all so much for coming, and have a great rest of the day, and we will follow up with materials.
Thank you so much, everyone. Bye-bye.